So you see Apple stock down, Google stock down, Tesla down, Microsoft all down. And right off the bat, you got to assume the market's got to be having a bad day. Your portfolio is going to be down. The indexes are going to be down if those sorts of big dogs are all down, right? Meanwhile, public account's having a very good day. The Dow is up here today. The Nasdaq's up today. S&P 500's all up today. And you got to say, what is going on? Like, what is really happening in this market when you have some of these traditional big dog stocks, huge market caps falling, yet the markets are going up? What is going on? Okay, so I want to explain exactly what's going on in this video here today. We're also going to get into how to best maximize gains in this sort of market we're in the transition, because we've had a big divergence that has now transpired. I need to explain that. And so how do you best maximize your gains in that sort of market? And last thing we'll get into is Fubo. Fubo reported earnings before the bell this morning, so I'll share my opinions and perspectives on what's going on with that stock, where the stock price is headed, the company, those sorts of things in this one here today. Okay, appreciate y'all joining me as always. Thanks so much for being here. All I ask in return, smash a like and make sure you're subscribed to this channel. I am feeling much better. I'm not 100%, I can tell you that, but I'm feeling much better than I did the last couple of days. So I'm happy to produce this video for you guys here today. And also I got a free brand new workshop for you guys, how much money you need to retire, quit your job, those sorts of things. Pin comment down there. It's absolutely free. It seems like a lot of you guys have really enjoyed that. So check that out. Okay. So let me take you back a little bit. Let me take you in the time machine a little bit to when I got in the market. I got in the market, end of 08 into 2009, started kind of exploring the market. And if we go back to that time when I first got in the market, these were the biggest market cap companies in the world. There was no such thing as trillion-dollar companies or anything like that in those days, and especially because we were in a stock market crash. It was during the great financial crisis, right? But when you looked at all of those companies, they all had one thing in common. And that one continuous thing they all had in common were they were needs-based businesses. ExxonMobil, oil and gas needs. Walmart needs. Procter & Gamble, you're talking about paper towels and toilet paper and tissues, things like that, needs. Microsoft need. Johnson & Johnson need. Berkshire Hathaway, they own so many different businesses across the board, and back then they did as well, not nearly as many as they do today, but all needs. Chevron needs, oil and gas, right? AT&T needs-based business. General Electric, JP Morgan, Pfizer, IBM, Coca-Cola, all needs-based businesses. None of these companies represented excitement, hope for the future, huge innovation, huge growth, or anything like that. Now, if I fast forward just a few years, we have a startling change that happened, okay? And this is where the story really begins. Check this out. So by 2011, now there were 3 companies that were among the biggest market cap companies in the world that really represented technology and innovation. And those companies were Apple, Google McDougal, and Oracle. These companies really represented the cutting edge of technology, innovation, hope, exciting new revenue opportunities, not just for themselves, but for other businesses with app stores and different services and things like that. Such an exciting time. Then if we fast forward to 2018, by that point in time, the top 5 market caps, the top 5 biggest all represented tech. They all represented innovation. So what a takeover in a matter of, we can call it about a decade or less than a decade, where you went from all the companies that were the biggest market caps were needs-based companies that were just kind of sleepy, to by 2018, it was all the biggest market caps were more tech-related, more innovation-related, right? Now, if we look at today, right, and we think about Apple, Apple's been one of the big dogs that has gotten the stock market to where it is, right? There's been a big fundamental change which has happened in many of these companies, like in Apple, for instance, right? Apple no longer represents what it used to represent. It used to represent growth. It used to represent tech, innovation, those sorts of things. And unfortunately, Apple doesn't represent that. And you can really see it in its numbers over the past few years. Tech companies, innovative companies, they don't have situations where their revenue is going negative on a year-over-year basis. They don't have situations where their revenue is stalling out. That's not innovation companies. That's not tech companies, right? That is more of a telltale sign of an oil and gas company. Let's call it a company that is more of a needs-based company, not an innovator at the end of the day, right? If we think about, I posted this up earlier this week, is something I saw that was great out there, Johnny Ive, and his contributions to Apple. He's a man behind AirPods, Apple Watch, iPad, MacBook, iPhone, iPod mini, iPod, the iMac. The man completely transformed Apple for the better forever, and he put the whole company in this place that it's at today, right? And this was the Apple that Johnny Ive and Steve Jobs built. But it's very different now, right? And if you look at a company like Apple, I mean, it's embarrassing. You could never even conceive of stuff like this happening in the past, right? Vision Pros are being returned because the headset, people don't know how to set it up. Like, that's crazy. Like, Apple, this would have never happened in the past. This is ridiculous. Like, this shouldn't even be an issue, right? 1 month with Apple Vision Pro in the air, on a train, and in a drawer. Up to 30% of Apple Vision Pro returns are because users don't get it, right? I mean, could you ever imagine Steve Jobs launching a product that had a ton of people returning it and saying, I don't get it, like, it doesn't make sense, I don't understand it, I don't know how to set it up, like that? No, that would have been ridiculous. Like, Steve Jobs never would have done that. The magic with Steve Jobs and Apple products was, from before you even got the product, you understood why you wanted it. Like, I need that. I want that. I can't wait to get that. And then once you actually experienced it, it even made you more excited of like, wow, this is like transformative for its day in age it was in. And you look at something like a Vision Pro and it's flat out embarrassing kind of what's going on, right? So Apple has become a Walmart. Apple's become an ExxonMobil. Apple's become a Chevron now at this point in time, which completely changes up the fabric of how you need to judge the stock market, where you need to see opportunities. Understanding a company like Apple is now these sort of companies, right? So the same thing is, not to just pick on Apple, but it's happened with Google McDougal as well. Google McDougal used to be the company of tech, innovation, of big things happening. But even Google McDougal, the $1.7 trillion market cap, they're in the same exact boat as Apple now at this point in time. Two of the big two companies that gave us so much hope over the past 15 years have become oil and gas stocks. Think about it this way, right? I think there's a potential of a next iPhone super cycle next year, because they're going to come out with bigger iPhones. Usually when bigger iPhones come out, they have a super cycle. But such sad, pathetic part of that is, if Apple has a super cycle of iPhones, it's no different than looking at an oil and gas stock and hoping that oil price is going to go up a bunch in the short term. So, the profitability of ExxonMobil and Chevron will shoot up massively for a year or two, right? It's the same exact situation with Apple. So the way you used to view an ExxonMobil or Chevron is the exact same thing you view an Apple now. Oh, somebody's iPhone breaks, they got to go get another iPhone because they're locked into the ecosystem. Somebody's MacBook breaks, they got to go get another MacBook or iPad because they're locked in the ecosystem. It's a very different thought process than traditionally with Apple 10 years ago, 5 years ago, 15 years ago, 20 years ago, right? Very, very large change. And like I said, it's not just Apple, it's Google as well. They're both the same exact situation. You look at Google, it's like, Google search is like, it has to be there. You kind of have to use it, no different than you have to use oil and gas, right? And if you look at YouTube, it's a must use. And so it doesn't mean these are bad companies, but you got to understand there's a very different way of viewing these companies now. And so you've got to view them in a line light, very similar to how you used to judge oil and gas stocks. And oil and gas stocks also usually trade at much lower P ratios and those sorts of things. So that is something to keep in mind as well. Now, we also have companies on the fringe of going over to that Apple and Google side of kind of being viewed as oil and gas stocks. Not quite there with these two big dogs, but I will say they're kind of close, okay? Microsoft, and including one of my investments personally, Amazon. Amazon's one of the biggest positions I have in the public count. The only thing that's keeping those companies from going into that Apple and Google category with oil and gas stocks, I call it, is Microsoft has, obviously invested so heavily in OpenAI. So that gives them that kind of super innovation there to kind of keep them away from being looked at as an oil and gas stock. And then Amazon with AWS and some of the innovation that's happened there, that's kind of kept them out of getting into that Apple and Google category of being viewed like, needs-based companies, and that's all they have to offer, right? So, excuse me, who are the real big tech innovation companies now, right? Who's the new leadership? And you got to ask yourself that, right? And then we'll get into where other opportunities are outside of these sorts of companies. Well, the new leadership of this stock market, the new hope stocks, the new innovators, the super innovators, the growth companies are these two. One is NVIDIA, and it's pretty self-explanatory. NVIDIA's market cap's now over $2 trillion. If they blow it out of the water again next quarter, NVIDIA could climb to the biggest market capitalization in the world. It could pass up Apple and Microsoft. They got to come through with one more quarter of booming numbers, beats across the board, and another super strong guide, and you will see NVIDIA pass up Microsoft and pass up Apple for the biggest market capitalization in the world. It's already past Google McDougal at this point in time. NVIDIA represents hope. It represents growth. It represents true innovation. It represents really changing the game, right? And pushing boundaries that people weren't thought possible. That's NVIDIA. And the other super innovator that's a big dog is Meta. You look at what they've done over the past few years with their stories feature, Reels, the Threads product, all the innovation on the WhatsApp side for the business side, AI for video and ad recommendations. It's clear as day. In the numbers, look at the growth rates of a Meta versus the growth rates of a Google or the growth rates of an Apple or lack of growth rates of those sorts of companies. It's a night and day difference, right? And so a company like a Meta is now seen as, wow, they're actually a super innovator. They actually changed the game. They actually represent hope and change for the future, right? Versus Apple and Google that are just kind of stuck in place. And so, you know, guys ever seen this movie, the Captain Phillips movie? There's that great scene. It says, look at me. Look at me. I'm the captain now. And that's NVIDIA and Meta. And Apple and Google just kind of standing there, and they're just, you know, they're bigger market caps than NVIDIA and Meta right now. Well, Google just got passed by NVIDIA. I wouldn't be surprised if Meta actually ends up passing up Google in the next year in terms of a bigger market cap than Google. And like I said, NVIDIA could take down everybody in the next, 9 to 12 months if they just come through and knock it out of the ballpark again. So this is a situation in the market. You got to understand you've got to invest a little differently in that sort of market, right? And to illustrate this point a little deeper, in 2022, in the NASDAQ crash, right? The NASDAQ fell 35% plus peak to trough in terms of where it peaked in Q4 of 2021 versus the lows in 2022 in the fourth quarter, right? And you look at Apple and Google, those stocks held up decently well in that crash. Meanwhile, NVIDIA was down 50%. Meta was down 60+% in that crash. So you can see in a scary market, people gravitate toward an Apple and Google because they're seen as more like needs-based, which once again puts them more into a category of a Walmart. By the way, Walmart's got way better growth than Google and Apple. You check out Walmart's latest growth rates. I mean, you would think they're the super innovator. It's ridiculous. But ExxonMobil, Chevron, these sorts of companies, that's the way an Apple Google seen. So if there's a big market crash, some people actually like to hide out money in some of those stocks, right? They're like, well, I'm scared about things, so let me just put my money in Apple stock for now. And that's the way a lot of people think. So the old days when you saw pull up the CNBC app or whatever you use to, just kind of check the market quickly, right? And you saw the Dow up, you saw S&P, you saw the NASDAQ up 1%. The old days you would say, oh, Apple and Google, man, they must be having a great day. It's changed now. If you see that, now you need to be thinking, oh, NVIDIA and Meta, they must be having a great day. It's big change that's happened now at this point in time. NASDAQ's up 1%. Oh, how much is NVIDIA up? 3%, 4%, 5%? How much is Meta up? 2, 3, 4%? How much is Meta up, right? That's a thought process now at this point in time. Now, you got to also ask yourself, what are the super innovator companies? What do they all have in common versus the ones that are seen as kind of more oil and gas related stocks now, needs-based, right? Well, guess what? They all still have the CEOs in place that built these companies, right? Elon Musk at Tesla, which Tesla's been going through obviously tough times because they're in the automotive sector, and automotive sector is very cyclical. It's up and down, right? So they've been kind of going through tough times, but Tesla still looked at as a super innovator. They still are. That's why the stock always trades very rich forward P on that stock, and it always will. At least as long as Elon Musk is at the helm there at Tesla, Tesla's always going to trade at extremely rich forward Ps because it's a super innovator. The things that they're doing at Tesla, they're just not being done at other companies. You can't do those things. You can't pull that off. It's impossible unless you're Tesla, right? And that whole brain trust of SpaceX and what SpaceX has been able to pull off, which is another Elon Musk company. I mean, you can't replicate that in your dreams, maybe, right? And then you look at obviously Meta in Zuckerberg there, and he's able to say, we're going over here, we're doing this, and you're doing that. And no one else has that sort of pull. No one else has that sort of confidence to do what Zuckerberg did and said, we're going to cut a massive amount of our employees, and we're going to launch an X competitor, and we're going to do this and we're going to do that. No, you just can't pull it off. Zuckerberg can. He owns so much of the company, and he's had so much success that he can do whatever he wants. Jensen over there at NVIDIA, he can do whatever he wants as well. He says we're going here and we're going to focus on this, and a lot of the success you see of NVIDIA and what they're having as success today. Remember, this is projects that were started 5 and 10 years ago at NVIDIA. And so when Jensen had his team start to work on these sorts of projects that are really come to fruition nowadays, right? And you're seeing the proof in the pudding and why NVIDIA might climb the biggest market cap in the world. That man put all this in place when this wasn't even seen as like a potential. This is like 10 years ago. Excuse me. Remember, I'm not quite all better. That wasn't even like thought of as like a possibility, but yet he was able to do. He was able to put that R&D there and said, tough, I know you guys don't understand what I'm spending all this money on right now, but 5-10 years from now, you're going to understand it. And now people are looking and like, oh, dang, we really understand it now at this point in time, right? So that's some food for thought there. Now, keep in mind, in order to see opportunities for super innovators, tech companies, the hope of the future, right? You don't need to just look at the big dogs like the NVIDIAs, the Metas, the Teslas for innovation, those sorts of companies. There's other opportunities out in the market way underneath those sorts of layers of those massive companies there, okay? I'll give you a couple examples, just so you can have a couple examples that, would fit this criteria, okay? Palantir, perfect example, right? Smaller cap company, super innovative, game changer, company is one of those that today is not looked at as a giant at all, but 10 years from now, you could look at a company like a Palantir and view this company very different lens, and you could view this as a dominant, massive market cap company 10 years from now versus where they're at now. Nowadays, they're just seen as like this, company that's very innovative. They got a lot of tech. They're spending on a lot, but a lot of people don't see what's coming for Palantir over the next, decade. And I think this is a company that's set up very well for the next decade. And I think everybody's going to see this story play out and be like, oh man, there it was. The super innovator, right? The hope, the change for the future. Another example of a stock is Shopify. Shopify is smaller cap company compared to stocks like Meta, NVIDIA, those sorts of companies. But I think Shopify represents growth. Shopify represents hope for the future, innovation. That's another founder-led company. Toby there at Shopify, he's a man that's built this company from, no one even heard of Shopify 10 years ago. And, he's the one that's built this company into what it is today. And I wouldn't be surprised if this is $1 trillion company 10 years from now. And people will say, they'll be able to look back and be like, dang, man, like, that's crazy. Like, that company was so innovative. They always had so much growth. And they were always focused around their customers, but they really, really pulled it off. And by the way, I got an in-depth video on Shopify there. In that video, by the way, that was released about 2 weeks ago in regards to Shopify. So before we get into Fubo's earnings, kind of where that stock's headed and all those sorts of things, let me just cap this story here. We're in a different market now at this point in time. We're in a market where certain old big dog tech companies are becoming old big dog tech companies, and it does happen over time, right? IBM used to be a super innovator. IBM used to be hope for the future. IBM used to be exciting. And then it wasn't, right? Intel used to be hope for the future. Very exciting. And then the problem with these companies, they get the monopolistic type position and they stop innovating the way they used to be innovating. They start focusing more on share buybacks. They start focusing more on dividends. They start focusing more on just trying to keep the market share they have because companies have become so big. They stop focusing on taking risk because risk starts to be seen as an enemy. The people that get promoted in these companies, as Steve Jobs would put it, the people that start getting promoted in these companies are more just sales and marketing people. They're not product people. And so at the end of the day, you have the cards come crumbling down. And so companies like Apple and Google, they're going to be around for decades to go in the future. And those companies are going to continue to pull in incredible profits. Apple, Google, companies like that, incredible profits. They're going to continue to for a long time in the future. But do not look to those companies for major outperformance of the S&P 500. There's going to be short-term time periods when they have exceptional outperformance, such as an iPhone super cycle for a year where everybody gets excited for a new iPhone and then that dies down. It's going to be very similar to oil and gas stock, and then there's going to be the come down from that after that, right? And so you just got to understand that's kind of going to be more of the game for these sorts of companies. Do not look at stocks like that to be the super growth for your portfolios, for the huge outperformance like they were back in the day. And like I said, they're going to likely be looked at more and more as safety over time, as more needs based, okay, which is, really intriguing to see that happen. And it happens. And by the way, what I just described to you, that's going to be NVIDIA someday. Someday that will be NVIDIA. It's not today. It's probably not 5 years from now. It might not even be 10 years from now, but someday NVIDIA will be a future Intel, a future IBM, someday, long time from now, but it will happen. Meta will be one of those companies someday. Tesla, even the mighty Tesla, someday will be one of those companies. But for those companies, it's no time soon because their CEOs are still relatively young. They're still extremely hungry and they're still pushing. And so, just a little food for thought there. I don't think Musk, Zuckerberg, or Jensen are leaving anytime soon. I think those guys are good for at least the next 5-10 years, if not the next 15 to 20 years. And so look, if you're wondering who's going to be the $10 trillion companies in the future, keep an eye out, okay? Next up here at Fubo. So they reported earnings this morning, and there's some good, there's some bad. So here's the deal, okay? If we look at total revenue up to $410 million from $319 million in the same quarter last year, so Fubo grew subscriber rate great. They grew average revenue per user great. They grew revenue great. I mean, those are phenomenal numbers, very strong numbers, extremely strong numbers, especially in a category, like this, that a lot of those companies are having trouble, right? Now, also very exciting is they're making a lot of progress in terms of expense-wise, okay? So if you want to look at, let's say, subscriber-related expenses versus their subscription revenue, they're down to about 95% now. That's versus 104% at this same time last year. If you want to take broadcast and transmission versus subscription, you're at about 4% versus around 6% at this same time last year. Sales and marketing around 17% if you want to compare it to total revenue versus 18% compared to total revenue in the same quarter last year. So that's good. Technology and development, roughly in line, actually down slightly. General administrative up a little bit, but you're going to expect general administrative is going to be up if you're growing your business, the way Fubo's growing their business, right? So operating loss, $72 million versus about $94 million in the same quarter last year. So they cut it by over $20 million. So this is good and bad, right? This is great. Fubo's making great progress. And if you're a Fubo shareholder, this is exactly what you want to see. The company cutting down those losses, the company shrinking all these sorts of expense numbers as a percent of revenue is exactly what you want to see. With that being said, the company's still taking huge losses, right? So everything's moving in the right direction, but the losses are still huge because of how far this company's had to come from, right? So my opinion on kind of where the stock goes from here, and by the way, I gave them a D plus in terms of their grade for this quarter. In terms of what I think happens with the stock price now at this point in time, I think the stock probably heads back to 250 to 350 before next earnings. That's just my guess. I think a lot of the fear in regards to Fubo is now out of the stock. Now that the earnings are out, all the numbers are, heading in the right direction. I still got to listen to the conference call. I'm looking forward to likely listen to that tonight or tomorrow. And I've got the fear out. The legal stuff is going to be the legal stuff as far as that goes. I think that big fear cycle's kind of out of it now. And in regards to the legal thing, that could be the best decision for Fubo long term because that could keep those big content companies as far as the fees they charge at bay now that Fubo opened that on them. So, I think that's my guess. If I had to guess, 250 to 350 the stock's headed back to before next earnings. At the end of the day, this is big, right? So if you look at global expenses as a percent of revenue, they're at about 147% in the same time last year, down to 118%. Now, if you take out the discontinued operations, then it was about 129% because that was about 18 percentage points there. So they went from about 129% to 118%. At this time next year, my guess is they'll probably be somewhere between 98% and 108%, which means they'll still be losing money, but those losses will be very minimal compared to the losses they've taken over the last couple of years. And so if that happens and we kind of get to that 98% to 108% by this time next year, I think Fubo will leave the gulag, which the gulag is the under $5 club at that point in time, because if that happens, then I think how people will look at this stock then at that point in time will be like, oh, they're not a BK candidate anymore at this point in time. They're going to get profitable, and then they could start pulling in immense profits as the business continues to scale. And also they make for a more attractive potential buyout candidate as well at that time, because then they're not taking big losses. So that's my guess in regards to kind of that whole situation in regards to Fubo. Obviously, high risk, high reward stock. You're not going to be $2 a share, $1.97 or whatever, and not be high risk, high reward. Okay. Appreciate y'all joining me as always. Thanks so much for being here, folks. I'm getting a little better. I'm not quite there yet, but it's okay. Okay. Free workshop for you guys. Pin comment down there. How much money you need to retire. I think you'll really get a lot of value out of that one. I know a lot of people have so far. Much love and have a great day.